Hello, everyone, and welcome to another episode of How to Sell Your Vision. My name is Moti Elkaim, and I'm your host for this podcast series. As always, our goal is to bring to you successful founders who have raised and can share tips from their fundraising journey with you, and investors who will give you tips from the other side of the table on how to build your pitch powerfully. And I'm very excited to interview our guest for today because this VC is not your traditional VC. Scott Chain, who is the managing partner at Comeback Capital and is a former angel investor who directly invested in 50 companies, is now managing a VC that is focusing on Midwest companies. And that's super interesting. And I'm going to let Scott tell you all about it. Scott, thank you so much for being with us today.
Thank you for having me.
Absolutely. So tell us a bit about Comeback Capital. What a unique story.
Yeah, so Comeback Capital is a pre-seed venture fund, right? So we're looking at companies that are generally less than 2.5 years old with a very small amount of revenue and a product in the market, probably like $1,000 to $30,000 a month in revenue, where we are writing $250,000 checks and helping to assemble that first institutional round, usually less than $750,000. We invest everywhere in the US except Silicon Valley, San Francisco, New York City, and Boston, because that's where 75% of the venture capital is. And so we have no interest in being where everybody else is doing something. We want to be where there's a shortage of venture capital and an overabundance of entrepreneurs.
So you're staying away from the big hubs where there is such a crowded space. And that's great because sometimes, and I've seen it with many founders who are coming in from other places, not New York City, not San Francisco, not Tel Aviv, that they feel that, the Silicon Valley scene might be too big for them. And then you're giving them that gateway to where they need to go.
Yeah, and to be honest, I think one of the problems that happens in the kind of hubs of venture capital is that the model becomes very different. So the early stage investors in most of the country are trying to put small amounts of money in to get companies to go to the next stage. They are not large investors that are trying to buy an ownership position and trying to basically find deals that are option value for the rounds they can really do, which is unfortunately the volume of capital in places like San Francisco and New York means that that's the dominant model.
Yeah, that makes sense. So, Scott, you've seen a lot of founders. As I said, you've directly invested in more than 50 companies. So let's start with a hard question first and then go easy. We'll do it the opposite way. If you're seeing a founder right now, he or she are heading to their first pitch and they have an opportunity to ask you a question. And that question is, Scott, I just need one tip for my pitch. What would that tip be? What would that key insight that you'd like to share with them?
So I'm going to tell you that the number one thing should start before they go to the first meeting, which is the first message they send to anybody, which is tell the person on the other side of the table why they have an interest in your company, right? What's in it for that investor? Why is that investor right for the company? Because otherwise, the investors who see basically, something like 500 companies for every one that they choose to invest in, they just get overwhelmed by generic messages that all say the same thing.
Right. And that's actually the first time I'm hearing it, to be perfectly honest, because a lot of time founders are trying to sell what we're doing rather than go with the somewhat basic sales approach of what's in it for you. And I'm assuming that when you're saying what's in it for you, we don't want those generic statements that says you can get 50x on your money. So
Right. And to be very specific, right? Anything that any founder is pitching me, I have seen it before. There's no amount of generative AI statements in that I have not seen in the past 6 months, right? I've seen every variation. I've seen every when crypto was hot, I saw every crypto variation, right? I've seen every SaaS for everything that's ever existed. So what's important in from my perspective is what is it that you're doing that is solving an actual customer's problem where you think I can add some value beyond my money?
Interesting.
Otherwise, why are you talking to me?
That is very interesting. So you're saying, look, you're coming in for the partnership, not just the money. So really understand why me, Scott, can help you build this company because it's more than my pockets. I'm here to help you make this company a success.
And to be honest, my pockets are not the deepest, right? So I have a small fund. I'm writing a $250,000 check into a company out of maybe a $750,000 round, right?
Right.
And so the value that I'm adding is I think of this like I'm a first grade teacher. My job is to get you to second grade, right? Not to get you into college,
I love it.
right? And so what's the milestone? Probably it's something like multiplication tables that you learn in first grade, maybe to get you to second grade, learn to read simple sentences. That's the key, and that's the milestone. So if you tell me, like, I need somebody who's going to be able to do a SPAC, I'm like, well, I don't actually haven't know anything about a SPAC. So don't talk to me. If what you want is like, I need somebody who can help me understand from their experience how you get software into manufacturing plants that are small to medium-sized manufacturing businesses in places like Detroit and Cleveland, where we've done that before. And it's like, how do we get to product market fit with our first 10 manufacturers? That I know how to do. And then the milestone is that it got done, right? That's what I want. And if people tell me, oh, you're going to get 50x for my generative AI thing, I'm like, I put that mentally in the same category as the emails I get that I just won the Nigerian lottery.
That's I gotta tell you, that's actually one of the most powerful way that anyone has ever positioned early stage funding. I'm your first grade teacher to help you get to second grade. This is amazing. So in early stage funding, and the traction is okay. Sometimes there is no traction at all. There is no revenue. Um, what is the balance of connecting with the founder rather than understanding the product and the industry? How do you balance that in your investment?
So we are very particular. So we believe that there is an enormous step function between 0 customers and 1 customer paying you
Okay.
money. And so we just don't look at people who have no one paying them any money. Now, we will look at people who have 1 customer paying them $1,000 a month. Like, we would do that if it was a B2B business, but 0 is an idea to us, right? And so that's the first part. Now, in terms of the balance, I've always believed that there are the 3 parts. I mean, people use this analogy, but I don't think they think about what it means. There's a jockey, there's a horse, and there's a race, right? The race is the market. If the race is too small, it's not got a decent purse, it's not worth doing, right? So when people go after $100 million market, it's just not a venture business. Then there is the horse. What's the product? What's the problem you're solving? And to me, this is always order of magnitude value proposition. So you tell me that some customer is getting a 10x ROI on the solution you're providing to their problem. I'm super interested. You tell me they're getting a 2% improvement. It's not a solution. It'll never
Okay.
fly. And then the third thing is the jockey. It's the founding team. This is the hardest one because you kind of can't get it until you spend a little time talking to someone, but there are these little tells. People who are slow to respond to you, generally, if they are slow on email, if they're slow to set up meetings, if they're slow to do that, they're probably slow to grow the company, right? It's like riding a bicycle, is another of my analogies. If you pedal too slowly, you fall over. You cannot
Right.
pedal slow on a bike, right? And then that's the other thing is like, do I believe that I could spend 10 years interacting with this person? Because that's how long it's going to take. And the truth is, like, I talk to a lot of founders that I think are brilliant. I'm like, really, I just don't want to spend 10 years with this person. I don't feel they're trustworthy. I don't feel that they're motivated. I don't care about them. I don't think they have a vision. That's very subtle and it's very personal. And frankly, that's why I think investors use and people, experts in the space, use the marriage analogy because it's personal taste. You might want to marry one person. I'm going to want to marry a different person. And it's not wrong that we have different taste.
Okay, I love this conversation by the minute. Seriously, this is really wonderful to hear. You spoke about the market size, and this is something that, as I'm working with a lot of founders, they come in with the old notion that they need to present the TAM, the total available market. Now, is it still the case? Because at the end of the day, if the total available market is 30 billion, 40 billion, isn't that just like what you said, the promise of getting 30x? It's like the Nigerian email. Would you prefer to hear about the addressable market rather than the TAM? Is there a purpose to present TAM anymore?
So, okay, I want to hear three different things. I want to hear that the ultimate market is large, but I don't want to hear these fake TAMs. And what I mean by a fake TAM is when people say the market for airline tickets is, I don't know, $500 billion, when in fact what they're doing is selling you on their online travel agency that's taking a 6% commission, because the size of the market is actually the commission times the number of ticket value of the tickets that get sold, right? That's the problem that people have. So you want to know that that number is big, but you also want to know it's not the SAM that I'm so concerned about. It's the target market initially. So I'm a big believer in the like Peter Thiel 0 to 1, this like, can we monopolize this small market? So if you tell me that your business somehow is going to dominate, I don't know, software for managing um, uh, commercial real estate in the Caucasus or Central Asia, and there's a reason why you can dominate that geography. I'm more interested than you tell me that like the global, market is this, because I want to know how you're going to get that first monopoly
The first
kind
bite,
kind of position.
right? Got it. That makes perfect sense. I actually love Peter Thiel's model as well. I'm also a fan of kind of the moderate success, the best scenario, and the unbelievable scenario. And I think some founders are still held in the notions of the back that you have to sell a big dream. You have to sell a big dream. Are we still there, or do you have to sell a realistic go-to market?
Okay, so I think a lot in terms of analogies. And so I'm going to give you my highway analogy, which is you're trying to get somewhere. And if ultimately you can drive at like 100 miles an hour down this highway, you're going to get there really quickly. That's like your $1 billion exit. But there's a traffic jam and it blocks the road. And then you have to get off on this road where you can only go 50 miles an hour and it's windy and whatever. And that slows you down. And then there's this other road that's like a dirt road and you can only go 20 miles an hour. And that's, what you end up with. In many ways, what I want to hear is the vision of that 100-mile-an-hour superhighway. I want to hear but if it doesn't work, there's this exit and we're going to be reasonable with this, $50 million exit kind of road. And then and by the way, there's this like acquihire scenario where, our technology is in such demand that we're going to be, at a minimum, we'll get acquired and, the business will operate. Now, I could even be losing money in that scenario and it's just the team. But what I want to know is that the team is going to like not be incredibly harmed if they go down a road and the outcome is bad. If people are going to face going into like a personal bankruptcy or something like that from the downside scenario, they're going to make terrible decisions all along the way. And so I'm not interested in that.
Right, right. That makes a lot of sense. I want to switch gears for a second and speak about the actual pitch. So you're in the room, a founder comes in, and there is a lot of talk about storytelling, the need to tell your story in order to connect with an investor. How are you seeing the power of storytelling, or the importance, I should say, of storytelling when founders are coming into the room with you?
Okay, so I have to give you a slight aside and say that I have a day job in addition to being a VC, and I'm a research faculty member at Case Western Reserve University. And I spent many years studying many aspects of entrepreneurship, including randomized controlled trials where we put investors into fMRI machines and look at brain patterns in response to founder pitches. So I'm going to tell you two things that we figured out from literally doing this. The
By the
first
way,
is,
I know about the Princeton experiment for brain coupling. I didn't know they did the same with investors.
yeah, so we did this thing. So number one, if founders are pitching, they have to pitch with passion about their venture. But the interesting part is the reason why the passion works is not because it's persuasive, but because investors will sit there and play with their phone and be distracted and not pay attention. And what passion does is it focuses their attention. They listen, hear the message, and you can't tell somebody who doesn't listen, right? So that's number one. The second thing is storytelling works because it creates in people's mind a chance for seeing a future that isn't there. And that is what triggers the emotional part of the brain, which you need to get an investor to invest.
And at the end of the day, and correct me if I'm wrong, you've invested way more than me. It's all about the emotional connection, right? There is the decision making process as logical as we want it to be. But you said, I want to know that I can work with this person, that I can tolerate this person for 10 years. It's like a marriage. So is it an emotional decision making process?
So I think what it is that there is a basic hurdle of kind of rational factors, right? And so if you think about this, like we invest in 0.33% of the companies that we see, right? So that's one in every 333 companies, right?
Right.
And so probably no, we're not going to even bother talking to more than 25 of those companies because you don't have time. And of those to get in those 25, the numbers and everything else has to work, right? Or they're not in the pool, right? So that means there has to be a decent market size. There has to be a value proposition for the customers. All that's on the numbers. But when you get into the pitch and you're one of the 25, if there's no emotional connection, you're part of the 24.
That's a great way to put it. And it probably, like you said, using the same generic language is not going to help you not become part of the 24, because people are just saying the same thing over and over again. Our company is reimagining, we are redefining, we are reinventing, we are revolutionizing. Does language have a part in blocking you mentally to a pitch?
So I will tell you that in written emails, like on stuff, we don't take referrals from third party investors that we don't know when they're full of superlatives, because I think that's just BSing me. Like, you can't tell me that someone who's largely unknown is the greatest thing you've ever seen. Like, by definition, we don't know yet,
Right.
right? I think that what you want to know is whether the founder believes in this, because if they don't, no one else will, and that's okay. But there's a point at which it becomes curvilinear. Like, too much is just like, I can't believe this person, right? And so people should think about that, right? I mean, and showing really helps, and evidence really helps. Like, if you show me customers that provided evidence that they love you, that's going to be way more convincing to me than you saying my customers love me.
Right. Right. And that is for those early stage companies, that's part of the grit, that's part of the execution, the hustle that I assume you expect to see. You want them to come in after they've done the research. They've shown some demand for the product. So it's okay not to have $1 million ARR, but it's not okay to come into a meeting with zero execution, or at least understanding that there is a demand in the market for it. Is that fair to say?
Yeah, absolutely. And I will say the other piece of this is we put in lots of little tests to see how much effort founders are willing to put in. And you would be surprised at the number of founders who give up when it's slightly hard to do a pitch.
Really?
Or yes, it's crazy
Okay.
how that works, right? Like, you just basically say, okay, we don't have enough information from your initial email to us. Could you fill out our intake form that's on our website that asks a few more questions? We
And they
lose
give up.
about half the companies.
That's insane.
Yeah, it's insane. I don't understand what part of this people think it's like watching the social network movie and like suddenly you're a billionaire. I don't get it.
That's so you're missing the intent. You realize very quickly this is not the founder who is 100% driven.
They have to, I mean, literally, if you're not going to be able.
That's not hard at all. Um, we are kind of coming to the end of the session, but I'd like to ask you about challenges in the pitch, because sometimes investors are challenging the founders with questions about the market, their understanding, their plan, their financials. Is that a good sign that an investor is challenging you? Should you be, because sometimes you get into a mental state of mind where like, he's asking so many questions, he's not into it. Is it the opposite? So we have to embrace the pushback. The pushback is a good sign. So this has been one of the most enjoyable conversations I've had. I'm so happy that we had the opportunity to talk today. For all the founders who are listening in, I think that one of the key messages that I got from you is that, one, we want to see the effort. We want to see that, there are the little challenges. Understand that there is an investor on the other side that wants to learn you, your business, and understand your intent and passion behind it. It's not the Facebook movie. So it's not the social network, guys. We'll have to hustle a bit more to get the money and the attention. Scott, thank you so much. For everyone who's listening to this, just a reminder, Scott is the managing partner at Comeback Capital. So if you believe that they are the right fund for you, then is that okay if I'll encourage everyone to reach out? And don't fall for the questionnaire trap. Fill the questionnaire. Scott, thank you so much.